Hello everyone, and welcome back to the Velocity channel, where this is your bridge to financial freedoms. Listen, today we want to go ahead and get rid of some of our loans, especially our mortgage. We haven't tackled that in a while. We want to explain to you the science behind velocity banking with an illustration so that you can actually implement this today. But before we get into that, I want you to like, share, and subscribe all around the world so that everyone can know the power of velocity banking. Are you ready? Well, listen, so am I. Listen, I want you to know that mortgage means death pledge. And if you are a borrower, you are slave to the lender. But today, allow me to be your Terry Tubman and set you free. All right. So as always, I want to explain what's going on here. We want to share with you that we do have a loan. This is a mortgage, $300,000 at the 6.365%. And that minimum monthly payment for them is going to be $1,850. Okay. We also have an auto loan of $30,000 at 7.5% interest rate. The approximate minimum monthly payment on that is $600 each and every month for 60 months. That's 5 years. If we go over to here, we have our line of credit. Of course, they're in debt. $15,000 is the credit limit at 21%, and they have a balance of $12,000. But what if I told you that them having a balance in this case was a good thing? Because we're going to show these people how to use their line of credit in a way that leverages their line of credit and does not eat them up. Does that seem like something we can work with? Do you want to know more? All right, let's go ahead and do it. Before we get a little further into that and dig deeper, I want to share with you how we as people were taught. Growing up, you got to make sure that you pay your bills each and every month. Isn't that right? And they never told you how to pay the bills, just that you should be paying every one of your bills on time. And you know what? That's true. But do we have to segregate our income so that we have zero in cash flow? Okay? Let me share with you what I mean. Let's say you bring in $5,000 each and every month. That's the national average. So we'll go with that, right? $5,000 each and every month. The bank told you that, hey, you should save, all right? $1,350. And they're also going to give you some suggested minimum monthly payments. Do you know why? Because banks make money on other people's money, right? $600 towards groceries, all right. $1,850 goes towards the mortgage. You're segregating your income again, right? $600 goes towards the credit card on that minimum monthly payment. And then another $600 goes towards your automobile, leaving you with a margin of zero. Does that sound familiar? What if I told you that the banks teaching you about money is like the foxes teaching the chickens on what to eat? Let me share with you just a little tidbit here. Since you know that banks make money off of other people's money, who do you think them teaching you would benefit the most? Now, I'm so thankful for banks and credit unions who actually do have their clients in mind, right? And that tell them things like, hey, that 6.365%, as we're going to see in just a little bit, is it really 6.365%? It's actually much higher, all right? So I'm thankful for the banks that do that. Shout out to PenFed, shout out to Navy Federal Credit Union, Truist Bank. We got a whole list of banks that do that, all right? But if you're segregating your income up like this, no wonder it's going to take you 30 years to pay off the mortgage. No wonder it's going to take you 4, 5, 6, 7 years to pay off your lines of credit, and you're pulling your hair out. Listen, what if I shared with you that your problem wasn't necessarily the money that was bringing in? Your problem isn't necessarily the line of credit. Your problem isn't even necessarily your loans. What if I told you that your problem was in the way we've been taught to allocate our funds? We were taught to pay from our checking account. We were taught to save for emergencies, right? Well, what if I said this? Instead of listening to the foxes, let's do this instead. You know the $1,350 that we put in the bank and it's losing value by the day? Let's take control of that. And then let's put the amount that we put in our savings, quote unquote, account, let's put this amount right here. So instead of us bringing in $0 in cash flow, let's now bring in $1,350 in cash flow. That's going to be very important as we see. Instead of using our checking account like we've always been taught and losing value and not having any leverage, what if we used our line of credit as our new checking account? Now, stay with me on this because I want you to see something. What if we were able to keep $2,000 in as a cash flow, all right? What if we were able to keep that? What if we were to get rid of this, right? Because that's the minimum monthly payment on our line of credit, on our credit card. And if we're putting our income inside of our credit card, do we need to worry about this minimum monthly payment anymore? No, we don't. So that $600 comes to us. So let's go ahead and add again $600. That's going to equal out to $1,950. Okay, listen, we'll keep it at the $1,950. So now with just those two moves, we increased our cash flow by $1,950. That's going to be very important because remember, we have loans that we need to get rid of. All right. Now, what we're going to do is we are actually going to put our income inside of our line of credit of $5,000, but again, $3,000, or let's go ahead and use this cash flow. 5,000 minus the 1,950, that's 3,050. Let's go ahead and use that 3,050 mark as our expenses. That means we've got $1,950, right, as cash flow. So let's go ahead and divide $12,000, which is our balance, by the cash flow, okay, which is $1,950, all right? Now, if it's okay with you, can we just go ahead and round this up to 2,000? Right? Now, this is a margin of $50, right? But I want you to know something. If we rounded it up to $2,000, okay, it would actually take us approximately 6 months, okay, give or take, remember, because we took off that $50, we added the $50 to make it the 2,000. So this will take you about 6 months to pay off. And boy, did you save in interest or what? Right? Because guess what? You're not going to take 4 years, 5 years, 6 years to pay your line of credit off. You're going to pay it off in 6 months. Does that make sense? All right. So now that you know how to pay your line of credit, you're paying your line of credit in a way that is very unconventional, but it works. Okay. Now let's go ahead and go higher. Well, remember the loan for the mortgage, right, which is a security, your home loan is actually going to be much, much higher on the effective loan scale. So that's going to be like 100 or more. So you don't have to pay this off very quickly. But that cash flow sucking loan called the auto loan, you want to make sure that you are paying that off quickly because it's sucking this $600 away from you unnecessarily. So what we're going to do is we're going to go ahead and take care of this auto loan first. So we're going to place that as our priority, since on the cash flow indicator scale, it does rank pretty low, especially lower than our Freedom Zone home loan, okay? So with this, what we're going to do is we're going to take from our income. Remember, this has been filled back up to the 15,000, so we can either deploy the 15,000 or maybe the 12,000 towards the principal of this loan. Now, if we did the principal towards this loan, let's say in the first month, maybe you want to do the second month, we're going to end up at $18,000 at the principal. So that means the 7.5% is going to be eating the $18,000 and not the $30,000. But what does deploying the $12,000 towards the principal do? Where are we as far as time collapse transactions are concerned? Well, that will jump you to month 26. Month 26 on the first chunking of the principal. Isn't that beautiful? Now, this is a 5-year loan, okay? This auto loan is, but you just jumped to month 26. If you continue, and of course you're going to continue to pay the minimum monthly payments, and as you are using your line of credit as your new checking account, remember, it's going to take you about 6 months to replenish up to the $12,000. So what happens when you are at the $12,000 again, okay, in available credit, and that 6 months has passed? What can you do with it? Can you deploy it again? You sure can. So now it's going to be 18 minus 12, and you can see how we are able to just get out of loans very quickly. So what I wanted to share with you, though, is after we are done with this auto loan, where does this cash flow go? That's the question. Where does it go? Because we got rid of the auto loan after about 13 months, just in case you're wondering. All right? That's right. This $600 goes towards the cash flow. So that means it's $1,950 plus the $600. That's going to equal $2,550 in cash flow. Now, remember, as you're using your line of credit as your new checking account, this $2,550 in cash flow is helping you to pay off your loans or your lines much faster, much quicker. So now instead of 6 months, right, it's going to be a little less than 6 months, right? And so that's the way the pattern goes. Now that we're done with paying the auto loan, we still got the mortgage. I know some don't think that, mortgages are a big deal, and that's okay if you don't think that mortgages are a big deal, but I want you to know that people that have auto loans, student loans, mortgages, they're getting them paid off in as little as 7 to 10 years. And I'm talking about 30-year, 40-year mortgages. They're getting them paid off. Why? Because they know how to allocate their finances. They know how to transfer, right, the money correctly. That's how. So if you're talking about this, I want to go ahead and clean it up for you here. If you're talking about getting rid of gigantic mortgages just like this, you're talking about having massive leverage. And this is what I mean. With the traditional mortgage, we have the principal and then we have the interest. And of course, mortgages are almost always front loaded with interest. That means in 2 years' time, using these numbers, the $1,850 each and every month, and we have the $300,000 loan at 6.365%. This is how much is deployed in that moment. Guess how much goes to the principal in 2 years? in about 2 years, $7,600 goes towards the principal, and $36,000 goes towards the interest. All right? $36,000 goes towards the interest. And this is on a 2-year. This is a 2-year example. So this is where you'll be if you want to continue to pay the mortgage just like this. Now, I don't know about you, but that doesn't look like 6.365% interest to me. Does it? It looks more like 115% interest. You know why? Because it is. If you want to calculate the real, get closer to the real number, which is the total interest percentage, hopefully they told you about that, it's going to be somewhere close to this. What you do is you take the interest rate, multiply it by 2, and then you add a 0, all right? Now, what I'm going to do is in this scenario, it's most likely closer to 115%, and you'll actually see that I'm being generous. That's being kind. It's probably much more than that, all right? So if you want to continue paying your mortgage like this, go ahead. But with one transaction of $12,000, or maybe you want to use the whole thing, $15,000, since we are going to be paying it off very, very quickly. When one transaction, you just saved $36,000 in interest. All right? So what are we going to do now? What we're going to do now is we're going to continue on our pattern of chunking this massive principal. So let's go ahead and say we're at $15,000. We want to use the whole thing. We're going to chunk it towards the principal. Let's say you got a HELOC, right? You got a second lien HELOC. You want to go ahead and move that towards the principal. Man, wise on you, all right? Even if you don't have a HELOC, of course you can pay the mortgage with your credit cards. Plastique and others know why people want to pay the mortgage with their credit cards. That's why they opened up that service, okay? So you can do it, all right? $300,000, right, minus $15,000 is going to be what? $285, all right? $285. Now, what is this 6.365% going to be eating on? The $300,000 or the $285? That's right, the $285. Now, with this, we're going to see something, all right? With the $285, because you deployed that, you're not going to give the bank $36,000. That's why we're able to get out so fast. We know the difference between interest rate and time and balance. What we're focused on is time and balance because we want this gone as quick as possible. We're going to be using our line of credit to do it. Now, you don't have to use the line of credit. You can also use the savings account. You can use any account you feel comfortable with as a deployment account. You can actually stack up and save to deploy, right? I call it training your dollars, right? You're training your dollars to deploy towards this enemy called the loan. Now, as you're continuing to pay that, you'll see that there's no way that you're going to be paying it off at 30 years because you are just hammering away at that principle. And that is what this whole thing is about. It's about hammering away at this principle so that we can capture this cash flow. Does that make sense? $1,850. What can you do with the $1,850? Man, you can do a lot. I know you can. But it all starts with changing our minds about how we are moving our money. A lot of times, people get caught up in the interest rate, not knowing that when you place your money towards the mortgage, you will never, ever, ever, ever be able to get that money back. Why? Because it is a one-way loan. But if you have something called a HELOC, guess what? That money you put in, a lot of it you can take out. Man, I want you to do what's best for you. And giving money to someone else is something we were trained to do, even from birth. Our parents were trained to do it. But living in this time, we no longer have to do that. There's a reason we switched from typewriter to computer, from horse and buggy to car, right? And I want you to imagine what you can do with this extra cash flow, right? Because you know you're getting out of the mortgage in as little as, 7 to 10 years, right? Doing it the velocity banking way, right? Making sure that the line of credit is going towards a good cause, and that is the destruction, the elimination of these loans. Now, like I said, you don't have to pay it off like that, because it is a pretty efficient loan. You can actually use the cash flow that you gain for other things and maybe have your rental properties pay it off. But it is something that I'd like to share with you. I think that helps. Please let me know if you have any trouble with this. We can help, as well as attend our Tuesday night webinars, man. We show people how to do this. The people with Money Max account already know that they don't think about this. They just put it into the computer, into the software, and the software says, this is how you get it paid off in as little as 5 to 10 years. The mortgage, the auto loan, the student loan, okay? So let me go ahead and get out of the way here so you can see this. We want you saving this. We don't want this number going towards the bank, okay? And of course, we want you to get the principal paid up as fast as possible so that you can do what you need to do with your finances, and that is grow them, okay? God bless you, and you take care.